Hi everyone! As widely expected, Wall Street ended last week with an impressive rally thanks to strong earnings reports. Stocks were trading without a clear-cut trend during the week. However, on Friday, there were lots of drivers that helped stocks rebound. The main one was the article published in the Wall Street Journal. It stated that some Fed officials spoke in favor of slowing down the pace of monetary tightening in the near future to assess the impact of rate hikes on economic growth. As investors began to revise the prospects of monetary policy, the Dow gained more than 700 points at the end of the week. The S&P and NASDAQ indices rose by about 2.4%. Nevertheless, lots of negative quarterly reports limited profits. Snap shares fell by 28% after the company forecast zero growth in the current quarter, triggering a sell-off among other social media companies dependent on advertising revenue. The new week is going to be quite eventful. Investors are looking forward to new earnings reports. This week, Apple, Microsoft and Amazon are scheduled to unveil their profit results. Apart from that, the flash estimate of the third quarter GDP growth, durable goods orders and PMI indices will be also in the limelight. Watch our video review and leave your feedback in the comments down below. Let's start. Wall Street is winning back losses thanks to an upward reversal. However, it's unlikely to last for long. If not in October, then in November, another sharp decline may occur. Despite such expectations, the short-term outlook is quite positive for risk assets. On Monday, the main stock indices climbed above 1%. Investors are still scoring gains following Friday's rally. Perhaps in December, the Fed will raise the rate by less than 75 basis points. It gives hope that the central bank may switch to a less aggressive tightening. San Francisco Fed President Mary Daly said that it's time to start talking about slowing the pace of the hikes in borrowing costs. The central bank should avoid putting the economy into an unforced downturn by raising interest rates too sharply, she stressed. Fed Governor Charles Evans believes that the Fed should raise the key rate to 4.5%. or slightly higher by the beginning of next year and then keep it at the same level. In light of dovish remarks, some analysts suggested that the regulator is unlikely to undertake a 75 basis point rate hike in November. On Monday, fresh reports signaled the weakening of the economy because of soaring inflation and high interest rates. The U.S. manufacturing PMI index declined sharply in October to 49.9, which was significantly lower than the forecast reading of 51. This is the first contraction in the sector since June 2020. The services PMI index dipped as well. The indicator turned out to be negative, missing market expectations. The composite index reached new lows, logging the second significant drop since 2009, with the expectation of the start of the pandemic. Thus, the outlook for the American economy may become more pessimistic in the future. The day before the Beige Book was published, it serves the Fed as a gauge when making monetary policy decisions. According to the Beige Book, the economic outlook has already become more pessimistic. The weekly initial jobless claims report showed a decrease to 214,000. So the reading was better than expected. In general, macro stats on the labor market are neutral. They do not contradict the scenario of the possible weakening of the labor market. The deterioration of economic prospects is rather bearish for stocks. However, they are now rising amid expectations of less aggressive tightening. Market players are cherishing the hope that the central bank will avoid an economic downturn and stop monetary tightening at the right moment. The Dow Jones climbed by 4.9% last week amid such expectations. Given the improved market sentiment and such a bullish factor as the earnings season, a drastic fall on Wall Street is unlikely to take place in the short term. However, traders should stay alert. The midterm elections in the United States are around the corner. There might be lots of pleasant and unpleasant surprises. The closer November is, the more cautious investors should be, carefully evaluating the possible risks. As for the collapse of the stock market, which analysts tend to predict from time to time, the probability is rather low. Although a similar situation occurred in 2008, since then markets have learned from their mistakes. The regulators will hardly allow the Lehman effect to cause another crisis, as the consequences will be devastating. If there are more signs of it, the Fed may slow down monetary tightening. Analysts also rule out a deep fall in the equity market. The S&P 500 index also rebounded, showing signs of further recovery. Its weekly gains was 4.7%. The indicator is unlikely to slip below 3,500 in the near future. Nevertheless, November may bring some surprises which could impact market movements. This is why the index could decrease below 3,500. However, analysts are confident that the index will barely slide below 3,200. Currently, investors are tired of pessimism and a non-stop downtrend. Stocks are extremely oversold. For this reason, investors are looking for positive factors to snap a losing streak. In this case, the renewed hope of a less hawkish stance helped the stocks resume growth. If there are no extremely negative reports that could influence the Fed's monetary policy decisions, Wall Street is highly likely to grow higher in the coming weeks. Bulls may return to the market as stocks have experienced a steep fall of 27%. This is why they can now purchase shares at an attractive price. As for the technical outlook, a bullish trend has begun to build on the S&P 500 charts. However, traders need to make sure that the resistance level of 3,850 is strong enough. It's located near the lows of August-October and the highs of early October. Now, analysts are unsure of long-term steady recovery. The current rebound may be short-lived and a new downward movement will follow. Despite such a risk, stocks are likely to add gains for at least this week. Last week, the heavy tech NASDAQ advanced 5.8%. On Monday, it scored fewer gains than other main stock indices due to a drop in Tesla shares and some Chinese companies. Tesla stock was down by 4.9%. A decline occurred after Elon Musk's comments last week. He points out that China and Europe are experiencing a downturn. For this reason, Tesla will not reach its goal of car deliveries this year. Musk also noted that demand in the current quarter was high, so he expects Tesla to be resilient to the recession. Tesla's price cuts have once again highlighted some challenges in the Chinese market. Last year, the company lowered prices in China in an attempt to be more competitive in the country. At the same time, in the United States, the manufacturer of electric vehicles has increased prices over the past year due to the higher costs of commodities. In general, Tesla's earnings report was relatively positive. However, judging by the latest news and Elon Musk's comments, there are more reasons for concern than for joy. Tesla's sales in the third quarter jumped by 56%, undershooting forecasts. An increase in cost seems to have affected the company's gross margin. The manufacturer failed to convince analysts of its resilience to the weakening global demand, high interest rates, and an impending recession in the global economy. Tesla will probably face lots of challenges this year given the third quarter results. Despite rapid growth last week, one should remain cautious. A bearish reversal may take place at any moment. Investors are unwilling to buy stocks this year due to the aggressive tightening. So far, Fed policymakers have made only dovish remarks. The regulator has not done anything that could signal a shift to a less hawkish stance. Besides, it's hard to predict when the regulator could do so. It appears that tech stocks and gold are likely to remain in negative territory. The bearish outlook remains relevant. Analysts assume that the current rally is just another reversal in the bear market. It's better to adhere to this trend until the charts begin to show clear signs of an upward movement. A breakout of 11,036 could trigger a fall to a new yearly low. There could be more steep drops and bull traps with short-term rebounds despite upbeat earnings reports and macro stats. Bears will remain in control until the main stock indices reach higher highs and higher lows. There are no strong fundamental factors that could ensure a steady rally. Rebounds have occurred from time to time, and there are likely to be more. This is why it's crucial to be alert. A rise in the NASDAQ above the recent high of 11,730 could help bulls regain ground in the short term. In the longer term, bulls have to push the index higher to cement an upward movement. That's all for now. Subscribe to our channel and keep close tabs on market developments. See you.